Do you have to pay back venture capital? The answer isn't quite as obvious as you might think. Now, a lot of people will say venture capital is equity, it's not debt, you don't have to pay it back, but there's actually some nuances. Today, we're going to talk about the differences between equity and debt, the pros and cons of raising venture capital, and stay to the end because we'll talk about how taking venture capital might actually put you in a worse situation than if you had taken debt. So first of all, you got to understand the basics of debt versus equity from an investment perspective. So debt is where you are basically borrowing money from somebody else, right? You don't own the money, you got to give it back, and you have to pay rent, right? Just like if you were borrowing somebody's house or borrowing their tools and you have to pay them for that rental. Same thing with the money. You're paying rent on that money, and that rent, we call it interest. So at the end of the day, though, if I lend you money as an investor, then what essentially is happening is I'm lending you that money, you're going to borrow it, and then you're going to pay me rent, interest for borrowing it, and that's my return, right? I'm kind of capped. But the flip side is if you don't pay me back the money, I can come after you because you owe me the money. It's my money, not yours. I can come after you and force you to sell assets, give me your business, whatever it is to make me whole, right? Because you owe me that money back. Equity, on the other hand, is where I'm actually buying a piece of your business. And you gave me stock for that. You gave me ownership in the business. So you don't owe me any more money because you've already paid me. You've already paid me with the stock that I now own in the company. And now my upside is that if the company does really well, when you sell the company, then I get my portion of ownership from that sale. Now the flip side is if the company fails and goes to zero, I also get my ownership percentage of that number. It just so happens that that number is zero. So that can be the benefit of equity, is that you don't have to pay me back. I already got paid, and I got paid in the form of stock certificates. The downside, though, is that if I give you $1,000 and you give me 10% of your company, and then your company goes on to be worth, $100 million, now I am going to get paid out $10 million. So in a way, my $1,000 investment cost you $10 million. Whereas if you had just taken my $1,000 as a loan and paid me like 10% interest, then that loan would have only cost you like $100, right? So equity can be extremely expensive, but the flip side is you don't have to pay it back. That also exists because there's this risk-reward scenario happening, right? Where if the company fails and I'm an equity holder, I don't have necessarily the rights to come after and take all the assets and sell them to get my money back. I'm just going to lose all my money, most likely. So there's a trade-off from a risk-reward perspective. On debt, if I lend you the money, right, you have a contractual obligation to pay it back. And if you don't, I can come after you to make myself whole. But the flip side is I don't get the upside when things go really, really well. As venture capitalists, we invest in equity primarily because we want the upside. That's how our whole business model works. Even when we invest in debt, which, by the way, venture capitalists do invest in debt quite frequently. So even when we're investing in debt, what we really want is equity. And we're doing that for a bunch of different reasons, mostly because we want to kick the can down the road around valuation. But generally, like VCs, we want equity because it's all about the upside. All right, so hopefully that makes sense, the difference between debt and equity. Debt, you got to pay it back because it's not yours to begin with. Equity, you don't because you already paid them back by giving them equity in the company. So let's talk about VC. Is venture capital really the right choice for your business? Well, let's talk about some of the pros and cons. So the number one pro, in my opinion, to taking venture capital is that your most valuable asset is your time. You get a limited amount of it on this earth. Venture capital can be incredibly helpful for accelerating your business, helping you grow really fast so that you can maximize the amount of time you have on this earth, doing other things than running a business if that's what's really important to you. All the time we talk about entrepreneurs that spend 10, 20 years building their business, right? And they build phenomenal businesses and they're really successful. But what if they could do that same thing in as little as like 5 to 7 years? And then they could enjoy the fruits of their labors, right, for subsequent years after that. That is what venture capital can offer you. It can help accelerate your business grow really fast. Another pro is this idea called blitzscaling. So this is popularized in a book called Blitzscaling by Reid Hoffman, the founder of LinkedIn. And he talks about how a lot of the great businesses today, the big brands in technology, use a strategy called blitzscaling to grow really fast. Essentially what they did was they raised tons and tons of money, and then they use that money to grow faster than their competition and really cement themselves as the leader. Great examples of this are like Uber and Airbnb that raised tons and tons of money and built incredible brands that really solidified them as a market leader. So there's a pro there, right? And that pro is that if you raise a lot of venture money, you can kind of get ahead of all of your competition and outcompete them from a balance sheet and cash perspective. The last two pros, in my mind, are if you raise money from a legitimate venture capital fund, it can help you when you're hiring, right? So when Sequoia invests in a company, it's a little bit easier to hire an engineer because that engineer may say, oh, wow, Sequoia invested? This must be a really interesting business. I want to jump in. So it can help with that. The other thing that I think oftentimes doesn't get the credit that it should is that by bringing on an investment partner, they hold you accountable. They hold you to a higher level, a higher standard. And that can be really important. Okay, so let's talk about some of the cons of venture capital. So kind of as the corollary to the pros, one of the cons is if you're going to take venture capital, you better be ready to grow fast and focus on getting big. Because in venture capital, that's what we care about. We care about getting into businesses that have the potential to become really big really quickly. That's how our whole business model works. We're looking for the outliers. And so if we give you venture money, that is going to shift the gears from like, hey, maybe I want a business that, grows profitably and does, fairly well, to like, we are going to throw everything we got at it. We're going to burn the bridges, burn the strips. We're going to go full hilt at building this into something really big, nonstop, right? And if you're not willing to sign up for that, then maybe venture capital is not for you. The other big thing is you're going to lose control. Even though most venture capitalists do not want to run your business, and they do not want to take a majority stake in the business and put themselves in that position, they are still going to put in place enough provisions that give them control over the things that truly matter. They're going to have a vote on when you sell the business, when you raise money, who you hire, how you spend, how you invest, right? You are going to give up a certain amount of control when you take on venture capital money. Now, that's not necessarily always a bad thing. I talked about how that could be a good thing in that it holds you to a higher standard. It can push you a little bit outside of your comfort zone, which is not necessarily a bad thing. But it is something you have to be comfortable with, is giving up a little bit of control and a little bit of ownership in exchange for growing really fast and getting some additional outside support. The last con is that venture capital is kind of a drug. Once you start on it, it's addictive because VCs, they're going to give you the money and then they're going to push you to grow. And in order to grow, you got to spend money. And if you're spending lots of money, you're burning lots of money and you're going to run out. And so you got to go back to the trough and get some more venture capital to keep growing. Because if you ever slow down, you'll end up in a really tough spot because you won't be profitable, you won't be growing, and there won't be very many buyers for that business. On the one hand, venture can be really good at accelerating and creating massive momentum. The downside is you got to keep that momentum, and in order to do it, you typically have to raise more and more and more capital. If you looked at Uber and you look at Lyft, where we are an investor, those companies raised billions of dollars to get to where they were because they were burning so much and growing so fast. Ultimately, it worked out for those businesses because they were able to establish themselves as market leaders and change how customers behaved in that space, and so it was worth it. But sometimes it's not worth it, and these companies just burn lots of money. So look, venture capital might not be for you. That's okay. Less than 4% of businesses raise venture capital, and I would argue even less than that should actually raise venture capital. There are a lot of other ways to raise money. We'll talk about that in other videos, but really, don't be worried if venture capital is not for you. It's not for everybody, and that's okay. Let's bring it all home to the original question, which is, do you have to pay back venture capital? Well, the easy answer here is no, because it's equity, right? I invested as a VC in your business. You gave me stock, ownership in the business. We're settled, right? Not quite. So like I said earlier, if I've invested, I want you to grow super fast. If you're not growing super fast, then I may use some of my control provisions as a venture capitalist to push you in that direction. So there's a little bit of lack of control there. The other area where this pops up is I need to get an exit. I didn't invest in your company because it gave me the warm and fuzzies. I gave you the money because I wanted equity in a business that was going to grow and get really big, and then somebody else was going to want to buy my shares in your company for a lot more than what I paid for them. Even though it's not really a loan, I want my money back, but I want it back tenfold, 20-fold, 100-fold in some cases. And so I may, as a venture capitalist, push you towards an exit when you may not be ready for an exit, right? There are many cases where, like, Airbnb is a good example of this. They went public not because they needed to go public to raise more money necessarily, but because their employees and their early investors were really pushing them to go public. They were like, look, you've been a private company for over a decade now. We need our money back. So even though it wasn't a loan, they were like, we invested some money with the expectation we were going to get a return on that money. And that's if things go well. If things don't go well, venture capitalists still want their money back. And the way that they get it is they'll put in provisions like a liquidation preference. Now, this is industry standard. It's nothing new or special, but that liquidation preference basically says that the investors will get paid back the money that they put in before any of the common shareholders, i.e. the owners, the management, the employees, get paid anything. So let's say you've got a business where you raise $1 million at a $9 million pre-money valuation, which means the VC now owns 10% of your company. Well, in that scenario, like, let's say the company now sells for like $500,000, or let's say it sells for $1 million. Well, $1 million is still a lot of money, but in that case, the VC could enact their liquidation preference and they would get all $1 million or 500,000, whatever that number is. They would get all of that and none would be left for the common shareholders. So even though venture capital is not a loan and you don't really have to pay it back because it's equity in the same way that you do with debt, VCs are really smart around pushing you to either get to an exit where they can get their money back, plus a multiple, or in a downside scenario, at least getting some, if not all of their money back before you do. Here's the key takeaway at the end of the day. Venture capital can be an incredible tool to help you grow your business super fast. You just gotta know what you're getting yourself into. It's not inherently good or bad. It's a tool like any tool. It can be used for either. And as long as you're comfortable with the risks on either side, then it could be for you. And if it's not, that's okay too. There are lots of other great ways to build a fantastic business. If you thought this was interesting, you might find my next video, Can You Invest in Venture Capital Funds, interesting. Check it out.